Welcome to the Capital Discussions Roundtable. I'm Tom Nunnermaker with Rick Rose, who's going to be talking to us about oil futures options trading. Before we do, a quick disclosure, the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And once again, this is for educational purposes only. So with that, I'll stop sharing my screen and switch the ball over to you, Rick. So, Rick, welcome. You're a longtime friend from the Sheridan community days and still running your trading group under Capital Discussions now, which meets every week. But this is the first time you've actually done a roundtable, so we're happy to have you, and you can share your screen and show us what you do about oil.
All righty. So I guess I just need to see the chat so that I can see people that chat.
Okay, and I see your screen, so that's working fine.
Excuse me.
And since this is the first time you're on, maybe you want to spend a few words on your background and how you got into oil and, that kind of your story.
Well, my history starts back like probably most everybody else's. I gave money to brokerage houses and had brokers maintain my account. They did a good job. They ran it up, and they also ran it back down. And I became a person non grata after I asked one broker that bought me JD Uniphase at $309, and I asked him why I still owned it at $9. He called me stupid. So with that, I figured I need to learn how to do this and I could do just as good a job of losing my money as he could.
Rick, I one time heard somebody said whoever originally named them brokers was very, very smart. Because that's what they do. They make you broker.
Right. So that's how I got into this. I took one, and being a neophyte at it, I took a couple of classes. And one of my first classes, they just touched on options, and I thought it was cool that you could sell something on a stock further out. If it's at X and you sold it at Y, and you could make money in between there, if it didn't do anything or went someplace. So that's how I got my first exposure, and I wanted to get more information and learn more how to trade options. I also found out the hard way that by buying an option, I was not very good at making money at it. I could do better buying stock than I could buying an option and making money that way, but I always made money buying stocks. So at that point, it was pointed out to me that there's only a 33% chance of winning if you buy the option, and you got a 66% chance of winning if you sell it, because the stock can either only go up, down, or sideways. So depending on which way you think it's going to go, if you sell it, it goes up on you, you win. If it goes sideways, you win. If it goes down, you basically lose type of situation. But so that's why I do what they call writing options as opposed to doing a covered type write. So after a few years of that, trying to make it work with all the butterflies and the calendars and the diagonals and this and that trades that were out there, and not perfecting any one of them, came the day when the oil crunch came in, and the Enron market makers decided to, after Enron went bankrupt, they all seemed to move over to the oil futures. That's when we got our run up from $36 a barrel to 142. It was in that time period. And then they proceeded to kind of control the marketplace there. So after that, oil went back down again and then was moving along nicely. And then it's amazing how oil refineries manage to always go down in the summertime. Either one of them seems to catch fire or something like that. So the oil companies seem to generate, increase their profit margin that way. That was something that I would have figured out in my business that I had initially. If I was always short merchandise in the summer months, I would have had more merchandise. But the oil companies always managed, I'm going to age myself here, 60 years, have never figured that out to have enough supply for this demand that comes up in the summertime. So they always jack up their prices because demand is high and that. But there's other factors in there too that business economics, I guess, play into the fact that you take advantage of the people that are on the road and not make life an easy situation. So when oil got to 450 or 425 a gallon here, I decided I looked at oil and I said, well, the oil companies are making money at it. I might as well see if I can let them pay my gas bill and nothing else. So my first trade I put on a straddle and looking to make $500, and I made considerably more. So that felt good. I did it the second month, did the same thing. The third month did the same thing. The fourth month did the same thing. And then the fifth month, I got a learning lesson. My initial starting point at that time, oil had a volatility of about, I think, up in the 40s. So you could do a 2 standard deviation expiration move, calculate that in there, and make a few $100. So that's what I was doing at that time. And this time, oil was at something like, I think, about 105. So I put on the trade, and in 2 days, it made a $2 move. Well, I got downwards, and I was short the 85 put.
So, Rick, that was a short straddle?
Yeah.
Okay.
I sold both sides, yeah.
Gotcha.
And I got 68 cents for that put when I put it on 2 days earlier, but after that $2 move down, that 68 cents went to $1.36. So in high volatility, you get some big changes in your option prices. So in that time period, I found oil usually go down and touch a standard deviation move and go back, return back up. But this time it went down, and by the time it hit 85, I looked at it and I said, well, do I want to, let it ride or close it out? So I ended up closing it out because I didn't want to have to explain to the wife why I'd lost so much money had I not closed it out. But as things turned out at this particular point in time too, I was also holding this thing till expiration. Oil went down to $77, and then by expiration it was back up into $87. So I could have made my target price on that particular month, but I did not have the intestinal fortitude to take a almost $80,000 loss had it stayed down at the $77 bracket. But so moving on, the rest of that year was a profitable year. The next year was 100%. Everything was a profitable year. And then I think December 2 years ago, I had one loss and then was profitable again. And then I had another loss last January wise. Both my losses have occurred in January so far. And now we're back on the win streak again. So that's where I'm at today. So basically what you're seeing on your screen is what oil is doing today. The biggest run up here is after the oil inventory report this morning. Just as you can see here, so this is at 10:30. We had a little bit of movement here. This primary movement here is from about the last minute or last 30 seconds before 10:30 when the oil report officially comes out, and then we got this. So it ran up and then ran back down and then ended up going down again a little more. And then so far they've liked the price of the projected price of oil, which is, let's see here. Hang on a minute here. This is not doing what I've wanted it to do. Okay, I'll do it a different way. So everybody can see. So at 10:30, the oil reported that we upped our inventory, the amount of oil that we have, to 13.8 million. They were expecting a 2.7. Last week was 6.5. So this is we've added more to the oil glut, and the price goes up. So which is a contradictory thing. As oil goes up, as storage goes up, the quantity goes up. Why is it should be going down? But in this case, it worked out well in where I'm at. So that's what today's oil report is. So the worst thing with oil is it has what is called contango and backwardation. In effect, what they're looking at is what the market makers figure oil will be priced at a year from now. And if it's higher than what it is, that's called backwardation. And if it's lower, where oil is, current price is going to come up to where it is it's projected to be a year from now, then that's contango, which right now we are in contango because we're basically, they're looking, if you look at all the oil trades, pricing, single one. All of them, you'll notice that the current contract was going to expire in 13 days. The actual hard contract will be. These are all higher priced oil. So by the time you get out here to N7, which is about November, December, they're projected at about $54. So these prices are going to basically come down to this one, move up to this guy here. So that's contango. And let me go back here to the daily. Okay, so I guess I didn't. You'll have to excuse me a minute here. So, Alan. So this is my current trade. I started this 8 days ago. Oil ran up here, so I moved 2 contracts up because the value of the option that I sold went up to 1.5 times what I brought in. So I rolled 2 up, and that's what this little dip is here, which has helped me make profit because these guys have really dropped in value. Where this one's basically hanging in, and like this one here is hanging in. But so this is an iron condor. It is the second most income producing method. It is the best, basically best dollar return. This, what I'm saying here is this has costed me $13,480 in margin. And its maximum expiration wise is 8,400. So if you take 8,400 into the 14 wise, you're a little over 50%. So you're getting 50% return on margin on basically a monthly basis. I'm shooting for half of this because it gets me, I can get in and out of the trade within 21 days, and the rest of the time I don't have any exposure to the market. I've made my money that I'm happy with, and basically you can make a good income at it. The biggest thing is you want to make more money, you increase your margin by putting on more contracts. I feel is best to shoot for half, but depending on what your trading style is, you can go all the way to the expiration, which is, as I said, where I started out at. But the last 2 weeks, getting that last 2 cents out of that contract, you come up to say, is it really worth the risk that you got yourself exposed to in case something catastrophic were to happen that nobody has any plans for? I guess that's for somebody else. It's not trade related. But so far, this guy has given me at least, I'm going to say, a 90% win rate, which I feel is pretty good. If anybody else thinks that that's not is better or doing better than that is great. But as I say, currently wise, I'm looking right now after 10 days in the market. I am currently sitting at 16% return on risk. And I say with the low IV wise, I probably we'll have to stay in it for about 21 days to get my target price. And
so, Rick, did you see the question about kind of general guidelines, like when do you put it on? Do you ever do anything besides condors, that kind of stuff?
Right now, as I say, a straddle, the iron, sell a naked straddle, iron condor, and unbalanced butterflies are the 3 strategies I had. I had a image that I was going to show the three of them, what they look like for everybody, but I can't seem to. I thought I had it on a desktop here, but I don't see it. And what I captured it on, looks like I deleted it. Did try to prepare for this thing, but even though it doesn't look like it. But as I say,
maybe you could just kind of just run down the rules that you use in your mind when you're putting a trade on. Yeah.
Yeah. No, this is. Let me go back to that. So my trading plan basically is, and it's best if you put on both sides, unless you really feel that if it's going to go in one direction, up or down wise, in a steep rate, then you could, just it's best just to put on the opposite side. But you put on both sides at the same time, 45 days out. I shoot for $1 on the short side each side, so or very close to $1. And this one here, I settled for 99 cents on the put side, and I think I ended up with 86 cents on the put side, on the call side. But both of them brought in, the call side got 99 cents a contract or a tranche, and the put side got $1.09 per tranche. So I say, why I choose $1 there is because, like I found out when I first started, 68 cents will double faster than $1 will, just because it's a smaller amount. It takes a smaller amount to double it, and $1 seems like a fairly decent amount, because that means you got to go up. It has to go up 50 cents before you have to worry about making any rolling type adjustments.
Rick, this is Jim. What's your edge? And that's a part I just don't understand. How do you end up defining your edge? Why do you have better probability, or how do you define your trading edge when you went with this trade?
Well, the trades I put on they have at least a 75 to 85% chance of expiring, out of the money.
Mm-hmm.
May have and at the beginning wise, it'll have, what I want to say, probably a 25 to 30% probability of touching the strike or strikes. And ideally, I'd like to have a 99% chance of it settling in the money, of it in effect not settling in the money.
Right. I know what you meant.
So I'm working probabilities. I'm not working. I don't know what other way to say it is. I'm trying to give myself at least a 75 to 85% win rate, chance of winning, which is better odds than I can get at any casino.
Oh, of course. But the challenge is how much you lose when you lose, right? It's the percentage of winning is important, but that's the challenge that I always saw with oil, is that when you do have those really nasty moves, you could have a 90% chance of winning, but if you lose, if you have a 90% chance of winning, and that means that probably you're going to lose 10 times as much. And I'm talking if you go to expiration, right? You're going to lose 10
Yeah.
times as much on your losing trade. So it really comes down to expectancy. And the challenge, or the reason why I never traded oil, was because the tails of the options are so fat, both up and down, which means that you got to pay a lot to buy that protection on the outside. And so now it comes to your risk management, okay, on how to end up going. And that's why, I was just curious about, what you, and I think some of the questions were this, what's your risk management when things go awry?
So far my losses have been up about two months worth of income, 2 to 3 months worth of income.
Mm-hmm.
So, and like I say, that when I first started this, I had 4 winning months. That loss I wrote there wiped out that first 4 months, and then the rest of the year I ended up, winning. So right now, I'm working on a better loss control program. And I have found that if you sit there and fight it by keep rolling the thing down, so you keep price underneath the tent, you can burn through a lot of margin, but you'll end up, for one, you're going to be going through that for the expiration, because you keep rolling the thing down, unless someplace along the line you get a real lucky reverse, which I have had.
Which does happen often, but every once in a while you do get a, kind of like the second half of 2007, right? When you go from 147 down to 32.
Yeah, that, you mean when Citibank told the world that they were no longer going to deal in futures?
Yeah. Well, that and
Yeah.
a bunch of other
Yeah.
stuff. But you know what I'm saying? It's
yeah.
those, and this is, I guess, what I fear, and I think this is what most people fear, is that whenever I've traded oil, let me be specific. Whenever I've traded oil, I've always had at one point make money, and then just get bitch slapped. Okay.
Yeah.
How do you stop that?
Let's see here. What? Let's see. That's not 5 years. Okay. Sorry about this. Oh, that's why. They haven't been trading J7 that long. Let's see. This is. You mean like this one in 15? These, when I back tested this is when this occurs, or these type of falls occur. Those are the ones I determined I wanted to stay out of. So you do have to pay attention to this 20 moving average on that end. This is where I say if you're going down in a hard down like this on the 20 moving average, you don't put the put side on. You only do the call side. So when you get, it seems when you do, it goes up like this, you can still make money, but you're going to be making 2 to 3 rolls between these expiration points when you get into it.
Mm-hmm.
But when you get on the negative side, they jack up the IV on you. So it's good when you go back into reselling it, but you're paying for it. You're paying more for the IV than what you picked up initially. So it's really a non-win situation, even though it does make the income higher, but it still works out to be a bigger loss. So if you got a strong, a 45, basically a 45-degree angle on the downside, and and it could be safe to say on the upside either. On a 20 moving average, you only put on one side of the trade. You won't make as much money, but you will have almost a guaranteed win, because by about 10, 15 days, as it keeps going down, you could probably put on two trades in that time period, and still be within 21 days and collect double the income on the call side in this case, or on the put side in this case.
That makes sense. I don't trade oil enough, so when it starts to move, does its momentum normally end up keeping it moving for some period of time? You don't get it seems here on this chart, you don't get a lot of big trend reversals. You get a lot of noise, but it continues its trend, and that there are only a few turning points.
Yeah, that's I guess I think is one of the nice things, is because after it gets done with this, it'll go sideways. So here's your chance to make back some of the money you may have lost on this particular area. But when it came to this time, this is expiration day, and you saw this type of a downtrend going, you put on just the call side. So then this trade for this particular month would be just been the call side on and no put side.
Mm-hmm.
And then same for this particular month.
Okay. Now, you've done the back testing. It makes sense to end up putting on just one side, in your opinion, more so than, say, the ratio, put on like 3 calls to 1 put side?
I just stuck with the simple trades.
Okay.
I haven't done any thinking along that line.
That's fair. I've asked enough questions. There are a lot of others in the chat. I don't know if you want to keep going on, or if you want to address those.
If you see some that I missed, because
some people had just asked about,
basically the election was a no contest thing for me. Oil didn't do anything during the election. We've kind of figured that with the results that something drastic would happen, but the market just said, oh, big deal. So that's the way oil's been going. Right now it's range bound, which is great for trading condors and that, or any strategy, strangle type strategy. So I wrote it up from here to here, and if you're in the trade a week before a move like this happens, in effect, I forget what the big cause was here, but this was a $3 move. This has little effect. Excuse me, little effect on the options. It will. Excuse me a minute. It's going to take away some of your profit, which you could, after get down to 50%. If you brought in $1, if it gets down to 50%, 50 cents, you could sell. Have a stop in there to buy it back if it gets to a certain point. But usually it'll go down to at least 30, 35%, which is basically where I closed out last month's. All I could get was 36. You had to give back 36% of what I brought in, so I got to keep 36, 70, 64%. But I still, overall wise, I still made I got 35% return on risk last month. But say oil is not as wild and whippy as everybody thinks. I mean, looking at the RUT and the SPX this morning, wise, oil had moved $1, and those guys had already moved 5. So I call $1 a lot less whippy than 5, but it's a psychological factor that everybody has to get over. I have looked at putting on trades at 60 days out, but the time decay there is so, it seems to be so slow that it really isn't. I guess what the return on investment's not as great going further out. 45 days seems to be a good happy value that you can be in it for like 20 days, and you can 21 days and make a 35% return on risk. Where if you're out 60 days, you're going to be in it almost 35 days to get that same type of risk. So, and I say the longer you got a trade open in the market, you're still open to risk. Like Jim was saying, it's some big move comes in to takes away your profit, unless you got some form of a stop put in there, which I personally have not done yet. But it's, as I say, I'm still an infant in this thing, so I haven't got all the bugs worked out of it. But I do know if you do fight it, you can usually win, but you can end up losing big too. So like everything, the risk reward is there. And say one of the months, a couple of years ago that I did fight it, I think I ended up making like 5 figures on the trade. But I say it was something I could have done without. I'd have been much happier just taking my 4-figure gain as opposed to having to sit there buy the contracts to help mitigate some of the losses that I incurred in the options trades. Well, I haven't played the long game that much to say that it's a safer. I look at making my money and going. Like there again, like Jim says, the longer you're in a trade, the more risk you're running to have somebody come in and like you're at a casino wise. If you're on a long win streak, there's going to come a point where that win streak is going to come to an end. So if you're in and out, and you walk away from the table a winner with 100,000 instead of trying to go for the million, which you'll probably end up losing 500,000 if you try to go for a million. But it's that type of mentality is kind of a gaming type deal. But here you got the probabilities initially when you start out wise, they're way in your favor. Because right now, looking at this, for this particular trade, the put side, I've got the 72% chance that this guy is still going to be out of the money. I've got a 55% chance that it's going to touch my short strike of 50, and a 28% chance that it's going to be, in the money. So with that, I like that one. But the one I like better is after the roll I did about a week ago. Why is this one's got that short on the call side's got an 86% chance of being out of the money, a 29% chance of touching, and a 14% chance of being in the money. So I'd much rather have those odds than what I've got on the put side. But the put side is an acceptable risk of being in the money. When that gets up to 50%, then I kind of start worrying. That would be another changing, adjustment feature too. And when it gets up to 50%, try to get your in the money chances down to a lower percentage rate.
Eric, did you see Andrew's question about why would you do or when to do a condor versus a butterfly?
The actual butterfly, I have never had any luck with those guys. I put on one time and the IV went up, or I forget, IV went down, I guess, and the income on that thing went down too. So that's kind of, I have not had any good luck playing butterflies. I do the unbalanced butterfly. I use a 1-4-3 butterfly with what that would look like. Let's stop showing that one. Come on. This is just arbitrarily picking a value here. So it's close to what I'd be doing would be like this. I want to buy. And the dollar on the. All right, so Thinkorswim, they call this an unbalanced butterfly, which I don't, because it's more of a butterfly and a debit. So I up that to 3. Let's change that to 4 and do the same down here at the bottom.
You put 2 butterflies on?
Yeah, 1 put and 1 call.
Okay.
So right now, so this is a 51, 52, and a 52.5. Well, I take this and I move mine way out because I know that protection there's a give me to the market maker. So I go 15 out. So 15 onto that would be 67. And 15 onto that, and 15 from that would be 28. Yeah, not that one. All right, so that would be the unbalanced butterfly. You got a real narrow range in here, considering this is going to expire here, and this expires in a week today. So if somebody was willing to take the chance of being between, figuring oil's going to be between 52 and 53 in a week, excuse me, you can make you know, 3,800 on one tranche. Where if you did the same, and you're looking at, so for the two of them, you're looking at $14,000. If you did a iron condor, you'll get the 14,000, but you'll have about an extra. You'll be over about $4,500 simply because when you buy this guy, the 53 and a half, and then the three here, this takes away about two of these. So in effect, you're virtually a two tranche straddle, where with the iron condor, you're closer to a three or four tranche straddle, depending on the number of legs tranches you put on. So I've been using four here of late, so that would mean I'm going to get almost double the money using the iron condor as opposed to the unbalanced butterfly, and I get the same risk.
So, Rick, what would you tell people if they're new to trading oil? What kinds of things should they look for? What gotchas are there? Things like that. What advice would you give?
On that, go small until you get comfortable with it. As I say, this is my only trade. I only trade oil. I don't trade the SPX. I don't do MasterCard anymore. I don't do Alcoa or basically any of the other stocks or indexes, just simply because one, you can easily get $3.50 a contract with oil, or actually any future. With an option, you have to buy. They let you do 10 lot for $10. So basically, a 10 lot and a single future option is the same thing in size wise. You're paying $10 for the option. You're paying $3.50 for the future. So there's $6.50 more that you're paying for SPX or RUT or MasterCard or any of those guys. The nice thing too is that with that, if you paid $10 in, you make a penny on the SPX, you'll get $10. You sell it, so now you incurred another $10 to get out of it. So now you're into it for 20. You made 10, so you just lost $10. No, take it back. You got $10. Penny. Oh, you make a dime. You make a dime, so you actually end up losing $19.80. Where in futures, you pay $3.50 in, $3.50 out. You make a penny that gives you $10. So now you got 7 less 10. So now you get to put $3 into your bank account instead of taking $19 out of it. That's the other beauty on the futures, is that the cost of doing business is lower, considerably lower than it is doing the traditional options.
And do you have like a rough, like a summary of your performance results for the last, say, year? Winners, losers, percent return, drawdowns, that kind of stuff?
Yeah. I say last year.
Well, whatever period you have.
Well, I got it by year because I use it. do that for taxes. The other nice thing about this too is that within your regular options, you pay uh, full regular income on it. This one goes 60/40 with I think it's 60% is capital gains, and then regular 40% is regular income on what you bring in off of the uh, your winnings. Let's see here. Come on. Let's just do it this way. This is what's going so far this year. So for February, I made 2,900 and well, so this is still active, so it hasn't been closed out. But right now, my potential win is about 7,500. But as I say, it's not my goal. As I say, that's still working. So I was in it from January 4th to the 27th. So it's 24 days. Had a maximum time in the trade. My maximum time in the trade would have been 43 days so I entered it on the 43rd day instead of the 45 days out. So that's where it's at today.
How about last year?
Last year I spent a lot of time on vacation, so
Okay.
Let's see here.
Sounds like Bob Hug. He's using Amy's nested iron condors to pay for his trips to the Caribbean.
Let's see. And I want documents. Okay. So that's last year. As I said, that's only trading basically half the year.
Pretty good, Rick. Andrew asked, do you just roll the shorts out to adjust your condors? Are there any other adjustments that you use?
The primary adjustment I use is a ratio and roll to roll out the actual short. I don't do anything with the long. So if I roll a put down to get it out of the way, then I'm rolling it closer to my the way out protection put that I have. So if I roll it down 2 strikes, so if I start at 45 and I have the protection at 30, yeah, 30. So the 30 stays put, but the 45 will get that rolled down to like 42, or depending on the roll number. Yeah, I roll to make a profit. So yeah, I'm locking in a loss. So I adjust the ratio to the spot that I recover what the loss is, and I add a little more. Maybe I'll only add 20 cents or 15 cents, but I want to do the rolls as small as I can. Trying to stay to the original trade, but also to that type of a situation, just keep it out of the way. So by that, what I mean, so in effect, the 53 put here was $1. So when that got to $1.50, I would be rolling it down to about 51.5, 52, depending on what the value of those are down there. But with this stage of the game wise, makes it difficult to roll it, because as soon as you get about 2 strikes past near the money strike, they drop off drastically. Let's see if I can explain that more clearly. So the 53 right now is basically $1.12. If you rolled it down to a 52, that's 63 cents. And if you try to get it down to 51, you're only getting 33 cents for the 51s. So the market makers, as I say, time decay is taken into effect. The market makers feel that it's not really going to move that much, so they're not giving you really a bunch of money for it. So anything past the 2 strike move down wise, you're not going to get much of anything. In fact, to duplicate this one here, you'd almost have to do a 1:3 ratio to cover $1.13 and 64. So at 120 as 120 a 1:2 ratio.
Well, Rick, we're right at an hour. Any last comments before we wrap it up?
Excuse me. As I say, oil is, last comment wise, oil is not as a rabid an animal as everybody wants to think it is. If you want to come into have more questions, feel free to come into the California Trading Group 1, and we'll go over that. There's another gentleman there. He's got another trading style, and we can go over, basically my style is not necessarily it's somebody else's style, but it works for me. It could work for other people, but everybody's got their own trading skill set and style. I mean, option trading and trading in general is a craft. It's not nothing that mechanically can be really engineered into it. It's like working with wood, as one educator said. It's just you become more proficient with a particular type of wood. You can do more things with it and make it look better, or make it shine even better. So, say in this particular game, I am not trying to make a gigantic, $1 million a year annual income. It's available there if you get the funds and intestinal fortitude to do it. It's easily made it that way, but I'm more into supplementing my income for the remaining days I have.
And the trading group you run is at 2 o'clock Eastern on Thursdays, which would be tomorrow, obviously. So
Correct.
if people do have more questions, just go ahead and join the trading group and ask away.
Yeah.
But
And if you want to start if other people are interested in the trading alert situations, that can be done too. So.
okay, well, maybe do a survey and see what kind of interest there is.
Yeah. If they're interested, I'm not really hiding anything, so.
Right. Well, I'm sure people could benefit from your experience, Rick.
Yeah. Hopefully, I've lost enough. It's nice to be gaining some of it back.
There we go. All right. Well, thanks everyone for participating, and Rick, thank you very much for sharing.
Okay.
And we will see you all next time. Have
all
a
right.
great
Thank
day.
you much. Yeah.
Bye.
Bye.